I did an interview, I forgot to record. Boy, I talked to an author for 2 hours. I said, oh, oh, gee whiz.
I hope you were taking notes.
I took notes, but I felt, anyway, I think we're recording. Okay. So this is for Naked Capitalism. I want to introduce Richard Vague, and the way I describe him to my friends is he's overtaken or accomplished, I think, an amazing American metamorphosis. Over 25 years, he's gone from being the CEO of both a Visa and a MasterCard issuer to becoming an economic theorist on the cutting edge internationally of economics. So he has a lot of data, he does a lot of homework, and he has actual hopeful news, which is, to me, an amazing thing to have at this point in American history. So Richard Vague, could you first just tell us, just so people who don't know who you are get an idea of what you can do and what you are doing and what you have done. How come you back in the early 2000s were able to see the 2008 crash coming when basically no one in mainstream economics did?
Well, thanks for your kind words, and thanks for hosting me today. Back in 06, 07, 08, really 05, 06, 07, now I was in the bank lending industry, and we were not mortgage lenders, but we tracked mortgage lending data because it was relevant to the consumer lending we were doing. And from 2002 to 2007, mortgage loans outstanding went from $5 trillion to $10 trillion. And mortgage loans, by the way, are the biggest single category of loans. You know, credit cards at that time were 600 billion. Energy lending at that time was 600-700 billion. Mortgage loans are the biggest category of private debt by far. And we saw it double in 5 years. And really, by the time you got to, 04, 05, it was the hockey stick to end all hockey sticks. And we became very, very alarmed at it and began making decisions, about our business and spending time talking to others about it in a way that reflected our concern. I'm not sure I foresaw a global catastrophe, but I saw a lot of big problems coming from that development. And as a general matter, economists don't look at private debt data, or if they do, they rationalize it. So it wasn't something that was alarming, even though it was obvious and should have been.
Okay, this brings up something that when I talk to my friends about you, this is one of many, but still about the chief insight I learned from you. And could you explain this for our bigger audience? First, explain the difference between private and public debt, and then again, come back on private debt. Most of private debt is mortgage debt.
Yeah, there's about $58 trillion of debt in the US economy right now. And well over 30 trillion of that is private debt.
So a little more than half.
A little more than half. It's been the bigger number all along. Private debt is a bigger total and therefore has a bigger influence on economic outcomes. And private debt is divided pretty equally between household and corporate debt. Household debt is about 15+ trillion, corporate debt is as well. The biggest single category within private debt, of that 15 trillion, about 10 trillion of it is mortgage debt. Then you have the smaller slices, student debt at about $1.5 trillion, credit cards at a little under $1 trillion, and so forth. On the business side, the biggest single factor is about $4 trillion of commercial real estate, the debt to finance the construction of new buildings and the like. And it's by far and away the biggest category of business debt. And after that, you quickly get down to $1 trillion slices in energy and healthcare and some other areas.
So would it be true to say that so much comes down to real estate, both people's personal home mortgages and business real estate? So much hinges on that in the American.
Yeah, and if you add mortgages and commercial real estate together, it's about 14 or 15 trillion, which is essentially half of all private sector debt. And it follows that if you have a runaway lending scenario in real estate lending, as we did in the period of 05, 06, if you have that happen, the real estate sector is so large that it's going to spill over to the economy as a whole. Contrast that to smaller areas of lending, like energy lending. We had a major lending catastrophe in the United States in 2016. Energy lending debt as a percent of GDP had more than doubled over the previous 5, 6, 7 years. And yet, since energy lending is only $1 trillion, I say only in the context of a 58, 59 trillion debt market, it didn't become a systemic national problem. It became an intense problem for the energy industry, but not much beyond that.
And this gets back to the topic of your previous book. What is the cause of financial crises? It comes down to what?
Yeah, to me, the defining characteristic of a financial crisis is the creation of overcapacity in the economy. We looked at 43 different crises over 200 years in the 6 largest countries in the world. And where you had a consensus major catastrophe, like the Great Depression or Japan's 90s crisis, or Germany in 1873, or Britain in 1866, it came from way too much of something. Railroads, as in the United States in 1873, housing, as in commercial real estate, as in Japan and in the 90s, and the United States in 1929. And the only way to create this massive overcapacity is through debt. There's no other way to create overcapacity. So the two are linked. And when you have a massive overcapacity situation, too many drilling rigs, too many houses, too many railroads, then a couple of things have to happen. Number one, economic activity has to shrink while the demand catches up to the oversupply. You have to lay off construction workers, as one example. So that's one thing that happens. The other thing that happens is those institutions that have been lenders to that sector have to fix their problem. In many cases, it's so big that the institutions fail or have to be propped up, but they have to recapitalize and repair and take several years to do that. So all in all, when you have a financial crisis, which is defined by this overcapacity and these lending failures, one of the ingredients to repair it is simply time, because you've got too much.
So time, but on the other hand, how ugly do these crises get?
Well, how ugly they get depends very much on the government's behavior in the crisis. So, financial crises all tend to look alike in the years leading up to the crisis. They can look very different after that point, because if the government intervenes forcefully, they can prevent a lot of the calamity. If they, absolve themselves of any responsibility, as they did in the early years after the 1929 crash, it can be terrible. The Fed and the government have learned more and more about this and tend to intervene in better and better ways to prevent as much widespread pain. You're going to have pain. You can have less pain if the intervention is successful.
Okay. And then just to sum up, would it be fair to say, or rephrase my words if you think if it's correct, if it needs to be corrected, what it comes down to is that the main cause of financial crises in this whole modern era, the last 200 and some years, for all the major economies, is irresponsible lending for private projects?
That's exactly right.
Okay, that's big news, or at least that's huge news to me. Then the second question comes down to inflation, because just, you know, I told you about my undergraduate education when I first met you. But everything that was forced into, you know, American undergraduates going back for the last couple of generations is that too much government spending causes inflation. And that's a tenet of faith almost. Can you comment on that?
Yeah, it's a very simple proposition to examine. We have a database of 47 countries, and it's very easy to query the database and say, you know, give me every instance, you know, this is 47 countries dating, you know, at least back to say 1970, but in many cases to World War II, and in some cases even beyond that. So it's very, very simple to say, you know, give me every instance where money supply growth or government debt growth exceeded, let's call it some big number like 50% for 3 years in a row. Those are high thresholds. And tell me, out of all such instances, how many times it was followed by high inflation. Let's call it higher than 5% for 3 years. And what you see very quickly is inflation almost never follows that circumstance. And in fact, many instances of high inflation occur when there has not been high growth in money supply or government debt. So the very premise is easy to examine, and then you quickly conclude when you do that the two aren't correlated at all.
And this brings up, talk about how you've gathered this data and why it seems that hardly anyone else has done this work, this basic homework.
You know, we don't claim to have any special knowledge or insight, and there's a lot of folks that we admire and have learned from. You know, our mutual friend Steve Keen is a great example of that, who have enormous amounts of data and, you know, do things that are very instructive. But I think as a general matter, folks don't focus on private debt. There's been the assumption in orthodox economics that, you know, for every lender, there's a borrower, and for every borrower, there's a lender, and the two kind of net each other out and therefore have no net influence on the economic picture, which is a very strange conclusion because debt creates money, as we know, and there's a vast difference between who the borrowers are and who the lenders are. The lenders are most often a very small number of very large institutions. The borrowers tend to be across the spectrum, but in relation to their income, there's a burden of debt that falls disproportionately on the less well-off, you know, average to less well-off Americans in the case of this country. So grappling with too much debt is a great reality for these borrowers and impacts significantly their ability to spend, you know, how much debt they have and how hard it is for them to carry it has everything to do with their ability to send their kids to college, to put an addition onto their house, to take vacations, to buy new cars and the like. So understanding private debt and its impact on day-to-day life across the broad citizenry, to me, is at the very heart of what economics should be doing.
But basically, orthodox mainstream economics does not do this.
That's right.
To me, then, and I'm not trying to exaggerate. To me, then, mainstream economists who would like to be who want to claim to be scientists or at least scientific, operate more like members of a religion or even a cult. They have certain narrow tenets they have faith in, and then they just extrapolate from their tenets, which have no connection with reality on the ground.
You know, I know plenty of good and helpful economists, you know, particularly those economists that kind of operate in businesses in the private sector tend to be more pragmatic and more hungry from the kind of things that I and others put forward. but you know, I think there have been a couple of folks that have said interesting things about this recently that I think are worth noting. Bill Gates, you know, he was, I think, commenting on the fact that no economist foresaw negative interest rates, as an example, and he was commenting with frustration. Too bad economists don't actually understand macroeconomics, which I think, you know, from a guy that smart is decidedly uncomplimentary. And then there's another comment that I think was very well put by a gentleman who was one of my heroes, and that's David Graeber. And you know, he put it, I think, very, very well. And by the way, we know he passed away tragically very, very recently, and we're all still grieving about that. But
he was only 59.
He was only 59. He was a vibrant intellect and a terrific individual. But he wrote, and I'll quote this: mainstream economists nowadays might not be particularly good at predicting financial crashes, facilitating general prosperity, or coming up with models for preventing climate change. But when it comes to establishing themselves in positions of intellectual authority, unaffected by such failings, their success is unparalleled. One would have to look at the history of religions to find anything like it. And he adds in the next paragraph, heterodox economists, you know, economists that have unorthodox views or different views. Heterodox economists continue to be treated as just a step or two away from crackpots, despite the fact that they often have a much better record of predicting real world economic events. And I think that's very much in keeping with my feeling about it. You know, science and other disciplines, there's more room for debate. Debate is more expected. There's a very tight orthodoxy within economics to the detriment of the field.
That's a very polite way of putting it, but still a very exact.
And by the way, I don't disparage individual economists. You know, they're trying to make a living too. So, but I do think, you know, I would call on them to be more open in examining alternatives,
to say the least. But you have done what? First off, would you consider yourself heterodox, if we're going to use this term? Does Steve Keen want to call himself heterodox? Do you want to call yourself heterodox?
I think Steve, being the feisty individual that he is, and by the way, Steve is one of my heroes, embraces the term heterodox. I don't care about labels. I care about data, and I try to go where the data leads me.
Okay, which is essentially the scientific method, is it not?
Well, I hope. But, you know, it's, you know, I'm sure what I do has all sorts of limitations, but we try hard.
Okay, so let's talk about what's hopeful at this point. Explain what we mean by a jubilee and how a jubilee could be applied. In this paper, you talk about 4 different areas that it could be applied to, and in a way that we could get politicians to actually enact.
Yeah, I mean, this is an overlooked phenomenon, but in the time when I've been on this earth, private debt in ratio to GDP, which is the proper way to look at it, it has tripled from around 50% of GDP to around 150% of GDP. So the average individual and business is carrying around 3 times as much debt in relationship to their income. Now, there's a lot of reasons for that. You know, some are meritorious and some aren't. But there you have it. The private sector is lugging around a lot more debt, and it is part of what suppresses consumption, spending, and investment, and is part of the reason, a big part of the reason, that growth these days is less than it used to be. You know, we grew at 4+% per annum in GDP in the 50s and 60s, and we're far below that today, you know. So we have tried to examine practical ways of reducing this private debt level. And, you know, there's several assumptions that we deal with in the paper. I don't want to try to deal with them here, but they're dealt with very specifically in the paper. Folks talk about outgrowing debt. Well, that never happens essentially, or certainly never happens in any significant way. That's not a viable option. And in fact, sorry, go ahead.
No, I just wanted to, my understanding, tell me if I'm not quite right. My understanding is that the way you grow is by taking on more debt. That's how growth occurs. So,
yeah, that's you've hit the nail on the head. How can you outgrow debt when it takes debt to grow? And okay. We get into that in the paper. And inflation is not a way to get rid of this debt, because the amount of inflation required is a cure worse than the disease. And furthermore, we haven't even shown that we could engender inflation if we wanted to. And I have some specific thoughts on that. Getting folks to pay down debt en masse in fact, would create a financial calamity on its own, because that would be money that would otherwise go to spending, and you'd see a GDP collapse. So really, if you examine carefully the options for reducing debt, by process of elimination, you're left with only one thing, and that is debt forgiveness. So then you have to ask, how can we, forgive debt? Restructure debt is probably a better way to put it. Restructure debt in a way that's fair, because some folks have big debts and some folks have small debts. How can you do something that's fair across the board? So that's what the paper. Sorry, go ahead.
No, I'm agreeing. Every time I say Jubilee, people say, well, then the irresponsible people are rewarded.
Exactly. So we try to put forward some politically pragmatic, realistic ways for us to deal with debt. So for example, we can forgive student debt by requiring a certain amount of community service, is one of the things we suggest. We can forgive housing debt by having the borrower give up some of their equity to the lender at their option, by the way. And so these are ways that I think address the fairness issue and are a big part of the paper that just came out. And then now, the net of it is, if we were able to get rid of a lot of that debt, it would be a boon to the economy. Folks are lugging around a lower burden of debt, then they're much more able to be active participants in the economy, and you'd actually see a very nice positive effect on the economy.
All right, and now with the numbers that you have right now, how bad is our current situation? You were sharing something with me about possible foreclosures or people not being able to stay current with mortgages and rents. How bad is that situation right now?
We looked at this, and I believe over the last year, because of the pandemic, we have 30-day mortgage delinquency that's in excess of 8%, I believe. And, that has meant that, you have over 4 million Americans delinquent that weren't a year ago. With the drop off in support from the federal level, we think that number is going to increase by a couple of million. So there's going to be a lot of economic pain. The household level, there's going to be economic pain in the lenders. There's going to be economic pain for landlords, many of which are small business owners that only own one or two or a small handful of rental property. All these folks are going to be negatively impacted. One saving grace, and it's important to note, is that we never had the ramp up in valuations of homes that we saw in 06, 07, or 08. There was not runaway mortgage lending, irresponsible mortgage lending leading into this crisis.
Right.
You're not going to have the risk associated with declining valuations that we had with the last one. And that's going to make this more manageable.
So the obvious solution that your paper suggests here is just fundamental restructuring of a lot of these mortgage debts.
That's a great option. Again, that can be done, that can be structured so it's at the borrower's option. We have suggestions for other areas of debt. All of this, even if we hadn't had a pandemic, these would be things that would be very salutary and beneficial to the economy, especially in view of the pandemic. There are things that should be strongly considered.
Yeah, this is urgent. I'm personally just aghast. What is going on in the Congress right now? It seems nothing is going to happen anytime soon.
There's been such a division between what the Republicans want and what the Democrats want that it looks like nothing will get done prior to November. We can always hope, but I think that hope is slim. So I think a lot of what will or won't happen boils down to what happens in the November election. If the Democrats keep the House, gain the Senate, those two things alone will portend, I think, relief, perhaps even profound relief beyond what we've received thus far. That doesn't happen, we're going to still be in this quagmire. And of course, the biggest factor of all is the presidential race, where different leadership, I think, would bring a very different and much more favorable outcome.
Okay, give me in detail, what would be a best case scenario? I want to hear a best case scenario.
In terms of the legislation?
But in terms of legislation, how could we turn this around and reduce a huge amount of private debt?
I think, I think the bid and the ask were, 1 trillion and 3 to 4 trillion or something like that. And the Democrats came forward and said they'd be willing to settle at 2 trillion or a little over 2 trillion. I think with 2 trillion, you're able to do a couple of things, which I view as the two most important things. One of those is you'd be able to support states and local governments. We face very large budget shortfalls all across this country on this issue. And so shoring that up, I think that number is somewhere in the $500 billion to $1 trillion range, that you can get a huge amount of that solved. And it's a solution that's time, because we're going to be back to appropriate levels of economic activity within a couple of years. At least that's what history would suggest to us. So that's part of it. And then, at least one more of these $1,200 like checks and the augmentation of the unemployment benefits. If we could do that again, that would be enormously meaningful. It'd be great if we could do more, but those are the things that I think represent the minimum of what we need to keep this economy doing what it needs to be doing.
One of the things, you recommended that great, Richard Ray, what's his first name?
Randall?
Randall Ray. Randall Ray, and you told me you just read Stephanie Kelton's new book on MMT. How much do your ideas overlap with those of the MMT economists?
There's a lot of common ground, and of course I have learned an enormous amount from those folks. I think Ray's textbook on modern monetary theory is one that everyone should read. It's very helpful. Stephanie is a marvelous spokesman for those ideas, and her book is a great example, a great document for further popularizing the ideas of MMT. So kudos to those folks, and they should keep doing the great work that they're doing. There's a few areas that that I have a little bit of difference with those folks, but by and large, I think what they're doing is of very high value.
Looking back in American history, can you give one or two examples of things done right in the face of a crisis?
Well, I think that, we have learned a lot. I contrast 1929 with 2008. In 1929, you had Andrew Mellon was Secretary of the Treasury. And the idea was, the government needs to be hands off. Hoover certainly tried to do some things, but he didn't do things in the most important areas. And those had to do with propping up the lending industry so that consumers didn't have to pay off their mortgages early. Back in those days, most mortgages were somewhere between 5 years and 11 years in maturity. And one of the things that happened in that 1930, 31, 32 period is the mortgages that were coming due were not renewed. So there was the poor homeowner who had been rolling over that mortgage with no capacity to pay off that debt. And that was a huge and central part of that crisis is since the banks were experiencing runs, they couldn't renew those loans. If the banks had been supported by the Treasury or the Fed, they would have been in the position to renew those loans. The fact that they didn't caused this massive contraction over a 3-year period. I mean, private debt shrunk by, well over 20% in just a couple of years. So the governments have learned from that. And I think Japan in the 90s did a better job, a much different and better job. And certainly the Fed in 08 and 09, not a perfect job, but they learned enough to keep us from having a almost 50% contraction in GDP, which is what happened in the 1930s. By the way, in 2008, 9, 10, the contraction was just a single-digit contraction. So we certainly learned a lot. And I think that learning has been applied to this most recent crisis, particularly at the Fed. So there's clearly been learning. There's clearly been times, many times, when the government acted appropriately to bring relief.
Okay, that being said, in my mind, looking back to 2008, 2009, the still open wound is the fact that President Obama didn't help regular people who held mortgages. And there were, 6 million foreclosures?
Yeah, I think the number was higher than that. But yeah, you're hitting the nail on the head here. The big omission, there's a lot of things we would do differently. But the biggest one by far is that you had 52 million mortgages in 2008. And the estimate is that somewhere between 12 and 15 million of those mortgages went underwater by an amount of at least 10% or more. And
so 1 in 7 or something.
Yeah, a huge number. And this is where some sort of forbearance should have been employed. I think the history of the United States in the 10 years since would be, or more than 10 years since would be very different if the average American been helped at that critical time. Our idea, as we say in the paper, was let the lender write the mortgage down to current market value. So if you had a $400,000 mortgage on a house that now only had $300,000 valuation, you should be able to write that down, that $100,000 down, and rewrite that mortgage for that borrower. So their mortgage payment is, dropped by at least, a quarter, and probably more because of the lower interest rates. That should have happened, and the way to enable that would have been to let the lenders write that loss off over an extended period. They didn't want to do that at that time because they would have had to have recognized the entire 100,000 times however many mortgages they had to rewrite. And that would have resulted in the failure of any number of those institutions. How about letting those lenders those servicers or whomever it is, write that loan down over an extended period. I suggest 30 years, could be 10 years, it could be 20 years. And the borrower would then cede to the lender some small amount of their equity on the the subsequent sale of the home, 5, 10, 20 years later, in trade for that restructuring. That would have brought enormous relief to, up to 15 million individuals or households in the United States. That didn't happen. That created a lot of discontent that lingered for years and years and years.
Yeah. Yeah, and now the problem isn't the valuation of the houses, it's that people just can't afford to pay, even if the valuation's 100% based on what the market is.
That's right.
And so could we have a similar response of the lenders? How could we do that now? Because the valuation doesn't need to be lower. How would the loan be restructured to help regulate?
I think in this particular case, the biggest thing needed is direct financial support to folks, as was done with the $1,200 checks, as was done with the augmented unemployment benefits. That's the most direct path here. There's other things to consider, but if we're looking to do something in the next month or few months, that's the surest path for this particular type of situation.
Okay, now that's exciting. So explain what you mean by perpetuals, and is this the same as helicopter money?
Yeah, we deal with this at length in the paper, so I don't want to belabor it too much. But one of the things that is commonly said, you read it all the time, seemingly everywhere, is that we can just print money, or the government just prints money, or fiat money, et cetera, et cetera. Well, the observation that I would have is that all money created in the United States these days is created by debt. So if the government, if you consider the government issuing debt the printing of money, well, certainly in that case, the creation, the money that goes into the government's account and the debt are two sides of the same coin, and you have debt created as a function of that event. When the Fed does its open market operations, it creates a liability, which is the entry into the account of the Treasury or the bank or whoever the counterparty is when they buy securities in the open market. When a bank makes a loan, that is obviously debt. The loan is on the asset side of the bank's books, and the customer's checking account is on the liability side. So all money that comes under the umbrella of this creation printing jargon is debt-based money. And we make the further observation that, we've looked at this over 47 countries since World War II, is that by and large, debt is always growing faster than GDP. So the debt to GDP ratio of pretty much every country climbs through time. The accumulation of debt, and I'm talking private plus public, by the way, not just public, not just private, accumulates through time, which increases the current carry burden on those countries. So what we need to do, I think, to change this equation is to find a way to create money that is not debt-based money. And this may seem like a radical idea, but if you look at the history of the United States, it's quite frequently the case, frankly, that the US government created money that was not debt-based. In the article, I talk about the creation in the 1860s of greenbacks. And we created greenbacks that I believe were equal to 5% of GDP and 8% of the cost of the war. And for the period of 1866 to 1879, which is the period before gold convertibility was restored in 1879, the average inflation was negative 3.5%. So the creation of this truly non-debt-based fiat money was not inflationary, and in fact was salutary to the economy. And the U.S. has done that many times along the way. I'm doing a pretty thorough study of Treasury secretaries in America's early history. And there was, quite a number of times where they issued Treasury notes that were, in some cases, non-interest bearing notes as a form of money.
Most recently, who did it most recently?
I think that happened under William Crawford briefly.
I don't even know who Crawford was.
He was our Secretary of the Treasury in the 1810s and
well, that's a while ago. Okay.
We spend a lot of time looking at this, and a lot of folks dismiss America's monetary history. I do not. We did this. We've done this at any number of points along the way. Not anymore. Our entire thinking about the money has become ossified, has become cast in cement, and we're not thinking outside the box. But this is something where I think we could change the equation on the government debt burden and our flexibility to support folks in something like the CARES Act with what, non-interest bearing securities that have no maturity that would facilitate the creation of money. And I get into that in the article in some depth, but it's something I hope stimulates a little thinking around this subject.
Okay, and since this is why you're calling them perpetuals, because they have no maturity.
They have no maturity, and in that sense, they have the characteristic more of equity than debt. And I think that's part of their power.
And in an ideal situation, if you had the power right now, how much of this type of perpetual money, should we call it helicopter money? What would be the best way to describe it to a general audience? What this money created without debt, what should we call it?
I tried to come up with a name for it: perpetual certificates. And, I think we need to be, if we did something like this, as we have done in our monetary past, I think you should keep some kind of parameters around it, $1 trillion or $2 trillion. I think you should put caps on it, which I've suggested in the article. But I think you can do helicopter money with or without perpetual certificates. I think the $1,200 checks that we just did under CARES were a form of what folks refer to as helicopter money.
Okay.
I think you can, if you did helicopter money the conventional way, it increases government's debt. If you use perpetual certificates, you would not.
Okay, that's an important distinction. How likely do you think any of this could happen? I want to hear something optimistic. Who is open to such thinking?
I don't think very many people are today. But I think increasingly folks are recognizing that the accumulation of debt through time just continues and continues to climb. We're at over 100% in the United States. We'll probably be, I think with COVID, that number will get close to 130% of GDP. Japan, as we know, is at 240% of GDP. We have this happening across developed economies. So folks might not want to talk about things like this, and they may not like this idea in particular, but they need to think of something. Something needs to happen to, and I think one of the ironies that's underappreciated is that the issuance of more and more debt is actually part of what's driving interest rates down. and interest rates going down is exacerbating inequality. And I get
Yes.
into that into the article, and would invite you to look at this. But you know, the seeming endless issuance of additional debt, you know, we need to start thinking about what, if anything, is that limit, and you know, should we be thinking of alternative strategies? And I think my article proposes one.
It certainly has. Now I just want other people to read it. So let's get other people to read it.
Well, we've had a great response to the article thus far. A lot of folks are reading it, and you know, my purpose with this is to engender dialogue, and hopefully it does at least some of that.
Okay, well, that's let's hope for the best, because that's all we can do. Okay, thank you. I'm going to stop recording now. Let's see. It was stop.